Welcome back. In our top business story, Dubai builder Arabtec Holding today reported its results for the second quarter. Net profit stood at 29 million dirhams. That's a drop of 74% year-on-year as the firm's general and administrative costs nearly doubled. However, the largest builder in the UAE by market value increased its net profit by 2.5 million compared to Q1, it said in a statement on the DFM's website today. Analysts say that earnings will pick up even more in the second half of the year, as Arabtec is expected to start a number of major projects in Saudi Arabia before the end of the year. Also, according to Reuters, Arabtec is looking to eventually more than double its workforce to 25,000 in Saudi Arabia, as it continues to shift its focus to other markets outside its home market, the UAE. Stocks in the GCC are seeing a sell-off today due to the uncertainty S&P's US credit rating downgrade coupled with a negative outlook caused. The main market index in the financial hub Dubai led the declines on Sunday, but also other Gulf markets closed lower today. This is quite worrying as the GCC markets are the first to react to the credit rating agency Standard & Poor's decision late on Friday to cut the US rating by one notch. Saudi Arabia's stock market was the region's only to open on Saturday when it plunged 5.5%. One reason is also that crude prices fell over 10% last week. Meanwhile, the UAE repeated it will keep its US dollar peg even after S&P's cut the US long-term credit rating by one notch to AA+, a central bank official told Reuters. Mohammed Al-Tamimi, Deputy Executive Director of the UAE Central Bank's Treasury Department, said the dirham is pegged to the dollar and will stay that way as the central bank doesn't see the dollar collapse. Currently, all Gulf Arab states except for Kuwait peg their currencies to the greenback. Tamimi added that he sees no credit risk in investing in US government debt at the moment. The UAE Central Bank does not hold any US Treasury bonds or government financial instruments. However, should the yields go higher to a justified level, there is no reason why the central bank will not invest in US Treasuries, Tamimi said. And let's now look at those stock indices that fell sharply today all across the GCC. World business news. Global policymakers held an emergency conference call today to discuss the twin debt crisis in Europe and the United States. Stock markets in Asia, Europe and the US are in for a shaky start into the new week due to renewed fears the rich world could slide back into recession. Meanwhile, the US Treasury Department labeled S&P's downgrade of the US credit rating as unjustified and called into doubt the credibility of its decision. There have been mixed reactions around the world to the downgrade. Over in China, which is the U.S. largest creditor, the official state news agency condemned the U.S. for what it called its debt addiction and short-sighted political wrangling. However, the head of India's state-run bank said the U.S. downgrade won't hurt the Indian economy. And also Australian Prime Minister Julia Gillard played down the importance of the downgrade.
Standard & Poor's had been signalling for some time that unless they saw, a certain figure of budget cutbacks out of the discussion that there's been in Washington about the American budget and fiscal consolidation, that they were intending to do that downgrade. At the same time, the other two major ratings agencies, Moody's and Fitch, continue to have the American economy rated at AAA.
Meanwhile, European Central Bank President Jean-Claude Trichet wants the policy-setting governing council of the ECB to tonight decide whether to buy Italian government bonds to curb the Eurozone debt crisis, an ECB source said. If the decision is taken to intervene to help ease the rising pressure on Italian bond yields, the ECB would start buying the bonds when markets open on Monday, the source said, according to Reuters. The ECB reactivated its controversial sovereign bond buying program last Thursday, but has so far only bought small quantities of Irish and Portuguese bonds. Italian Prime Minister Silvio Berlusconi announced further austerity measures late on Friday to calm the markets and prevent Italy from suffering the same fate as Greece. A series of hacking attacks underscores that governments and companies are losing the war against cyber thieves, with the costs mounting. A U.S. report showed that cyber intruders breached the computer networks of 72 organizations around the world over a 5-year period in the biggest hacking campaign found to date. But not only are cybercrimes increasing, they're also costing companies more money, another recent study has found. The median cost of cybercrimes for a company per year rose to $5.9 million, up from $3.8 million in 2010, while the number of attacks rose by 44%, with at least one large U.S. company a week falling victim, according to a study released by the Ponemon Institute. Before we go, here's a quick overview of the oil, precious metals and currency markets, and after that we have the day's sports news for you.